Well, in terms of pricing, so the USDA reported their updated numbers last night. In corn, only 58% of the intended plantings have been done versus 90%, which is historical. And soybeans, only about 30% has been planted versus about 65%. Going back in USDA data since 1980, it's never been this delayed. And you have a situation where stocks to use, which is basically inventory numbers with crops, have been very low for a while. We've seen robust plantings over the years, but the demand has been more than offset that. So now that the market's in a situation where you're going to have very low inventory levels, very slim plantings, and by next spring, it could be a real issue.
All right, what about the trade war and the retaliatory actions from the Chinese saying that they don't want our soybeans or some of the other crops that they used to buy? Will this offset that, or will this more than make up for that?
Well, I think we've already seen that impact in soybeans, because that's really pretty much what they've been importing. So soybeans that were over $10 a bushel got down to $8. Now we're seeing it creep up again. The most notable rise, though, has been in corn prices. And while China still imports corn, it's not as big a customer of ours as soybeans are.
I don't really think we see it in grain prices. We see it in meat, don't we? Is that where we really see that? What would you buy? I mean, if you were playing commodities, what would you buy? Live cattle or
pork
well,
prices?
It'll eventually certainly show up in that, yes. Yeah. But corn, soybeans, the crop prices have been in a bear market since 2012. Okay. It's been a rough 7 years for farmers.
Tough for farmers, but God, isn't it the abundance that we have with, I think, what the entire farming industry is 1% of what it was 100 years ago in terms of manpower, and we're just so good at it.
And the technology, too, to allow us to farm 200 bushels of corn an acre versus what we were able to do even 20, 30 years ago is really unbelievable.
Yeah, it's wealth. It's a wealth of, it's too good almost for the farmers, because they can produce so much at this point. But when we see the Fed worried about hitting 2%. Can this be this can't be the answer, can it? This is not something that they can hang their hat on and say, we were effective in getting it back to 2%. This doesn't count, does it?
No, like you said, they'll exit out.
Right.
It'll just be X'd out in the calculation and assume that this is just a cyclical rise rather than something more than that.
And I don't know, there's flooding and things like that, so it's not really a proxy for growth or global economic growth either. What about copper?
Weather.
What about oil? What about that complex? What about the 10-year and some of the sovereigns around the world? What does that tell us, Boockvar? You work at Bleakley. You always think things are bleak.
Well, it's clear that the yield curve is even speaking louder than those commodities, but certainly copper, recent drop, particularly since the May 5th tweet. And then obviously oil prices, but even those commodities have supply issues. It's just now the worries about demand has overwhelmed the worries about supply. But to me, the yield curve is the one that speaks the loudest as to what the market's viewpoint is on growth.
So you're suggesting a little food price inflation is just fine, given the rest of the economic backdrop? Is that fair to say?
Well, for the sake of farmers that have had a rough time, yes. For the sake of that fast food restaurant owner, that's dealing with higher labor costs, their margins are tight as it is. So food prices are about 30% of a restaurant's cost base, with labor making up pretty much most of the balance. There's not much room to handle a rise in food prices. But it takes time to work its way through. This can just be a spike. We have to see the sustainability. I happen to think this could be sustainable until next year, until we see spring planting next year.
We did already get some warnings from Chipotle and from Hormel about pork prices, because they've been up about 50% even before this.
Right, and exactly. So that adds to it. So if you're McDonald's, you're making the meat, you're using, your soybean meal is going into your finished products. I mean, again, on top of the labor costs, it's the combination that makes it tough when you got a business that's already got thin margins to begin with.